Hi, everyone. Thanks for joining us for this quarter's presentation. I'm Ryan Lehman, iCM's Director of Investments, and I'm going to be your host. Over the next 20 minutes or so, I'll be walking through the state of the closed-end fund market, as well as providing an update on the performance and positioning of our tactical income strategies that extensively use closed-end funds as part of their tactical asset allocation. Now, if you have any additional questions or would like more information on our tactical income strategies, feel free to reach out to a member of our advisor services team. We'll have all that contact info available at the end of the presentation. And with that said, let's go ahead and jump right into things. So just to start with universe-wide discounts, at a high level, it didn't look like things changed much over the quarter, but we did see some interesting dynamics if we look across asset classes. So most notably, discounts for taxable bonds gapped out by a little over 100 basis points. Now, there doesn't seem to be a fundamental reason for this, with credit spreads still pretty close to historic tights. So what we can likely chalk this up to is just simply investor fatigue and possibly some profit taking here with some really strong returns on a year-to-date basis, and discounts entering the quarter pretty well inside their historic norms. Now, we did see the exact opposite within munis, where discounts narrowed by around 100 basis points. Here we saw an uptick in investor demand for munis in general, as well as technical and fundamental concerns starting to fade a bit in Q3. Now, on this slide, we see just how the discount environment changed on a quarter-over-quarter basis. And really, in all honesty, there's not much to talk about here. So our distribution, that's on the left, that's essentially unchanged from last quarter. And then on the right, you're going to see that we still have just about 80% or so of funds trading at a discount to NAV, which is going to be slightly above that long-run average. That's about 7.6%. Now, to switch gears a bit and take a look at some of the key drivers of closed-end fund discounts, we're going to start here with interest rates. So interest rates in closed-end funds, they tend to exhibit a negative correlation, meaning that when rates decline, closed-end fund discounts tend to narrow, and then when rates rise, they tend to widen. And this does typically occur with just one caveat. So when we have rates declining due to an event of extreme market stress, so think like the COVID pandemic or the financial crisis, you do tend to see this relationship actually flip and turn positive. And then on this slide, though, just to expand a bit, what we're looking at is the yield on the 10-year U.S. Treasury. That's going to be in blue. And then the average muni bond fund discount, that's going to be in orange. So here we're going to use munis because they do tend to carry more duration. They're more interest rate sensitive than the taxable side of the closed-end fund market. That's going to be more credit oriented. We're going to look at that in a second. But just to talk about what happened in Q3, we did see rates come in a bit, which played somewhat of a role in discounts for muni funds. But I think that rally that we saw last quarter was going to be more directly due to investor demand, as I mentioned a little bit earlier. So munis had lagged for much of the year, but they saw a rebound of about 3% in the third quarter alone. So a really strong quarter for munis, which likely had a pretty significant impact on the discount environment. So next, just taking a look at the relationship between discounts on taxable bond closed-end funds and credit spreads. So spreads declined during the quarter. They touched some of their lowest levels in the last 20 years or so. Surprisingly, though, we actually saw discounts widen out a bit for taxable bond funds. Now, this isn't new. We have actually seen this occur a number of times in the past. And it looks like what this may be is just a result of investors looking at the discount environment and the returns that they've gotten over the last year or so, and honestly, probably just taking a little bit of risk off the table. And that said, taxable bonds, they do still look pretty frothy today from a historical perspective, even though they gapped out a little bit. The average fund, that's currently trading at just over 2.5% below NAV compared to a long-term average that's going to be closer to about 4%. And then lastly, here we're going to see the relationship between equity market returns and broad closed-end fund discounts. And in terms of this relationship, behavioral finance, or that tendency for investors to over and underreact to news, that's going to play a primary role in driving closed-end fund discounts because, as many of us know, the closed-end fund market, it does tend to be very, very driven by retail investors. And that's exactly what you see on this chart. So declines in equity market returns, high volatility environments, they tend to cause closed-end fund discounts to widen. And then on the flip side of that, periods of strong returns, low volatility, you tend to see discounts narrow. And like I mentioned already, here we're going to see that universe-wide discounts, they were relatively unchanged on the quarter. This again it's a bit skewed by the action that we saw across varying asset classes, but I think it's also a bit impacted by where discounts are relative to their own history. So munis still look relatively attractive, but if we look at just about every other asset class, they're trading at or inside their long-term average. And this is just going to put somewhat of a cap on future narrowing from here. That's not to say that there aren't attractive opportunities to be had, but with where discounts are today, I think what it really does is it makes the case for approaching this asset class in a tactical way versus just buying and holding something like a passive ETF closed-end funds. So I think that's a perfect segue here to talk about our flagship TICE strategy. So first, if we look at portfolio attributes, our closed-end fund exposure, it did decline pretty meaningfully on the quarter. We did have a number of fair value sells, but we also had a handful of funds that were actually liquidated at NAV, which directly benefits performance for the strategy. And the reason for that reduction in closed-end funds, it's going to relate directly to the current level of discounts that we've been talking about throughout the presentation. Discounts have come in pretty meaningfully over the last couple of years, and spreads are pretty tight. Now, from a discount standpoint, though, at quarter end, we saw our average closed-end fund holding that was trading at a discount of just about 8.5%. This is generally in line with where we ended Q2 and more than 150 basis points narrower than what we saw at the start of the year. This was additive to performance, something we're going to see in a couple slides when we look at attribution. And then as of quarter end, TICE was offering investors a distribution yield of 4.35%. This has come down a bit. There's really two reasons here. So first, interest rates and spreads, they broadly declined on the quarter. And then in addition, like I mentioned already, we did reduce our overall closed-end fund exposure pretty meaningfully on the quarter. Now, to speak to where we're finding the greatest opportunities, so here we're looking at the closed-end fund versus ETF breakdown for each sleeve of the portfolio, along with the average discount that's currently within that sleeve. And what you're going to notice is that we're clearly finding the least opportunities in U.S. equities and taxable fixed income. So there we've got 78% and 74% of our allocation to ETFs, respectively. To talk about U.S. equities first, this has been relatively high for much of the last year or so, as discounts never really gapped out for equity funds on a relative basis, at least. This was true after COVID. It was even true after the whole Liberation Day debacle that we saw earlier this year. However, one key observation, though, I do want to make in regards to our U.S. equity allocation is that despite the universe not looking so great as a whole, the funds that we are invested in are trading at pretty attractive discounts. So they average more than 11% below NAV at quarter end. And then similar to U.S. equities, within taxable bonds, the funds that we do own are still trading at attractive valuations. So there we've got an average discount of more than 8%. So just to kind of sum up, the environment's not ripe with opportunity here, but we are still finding some pretty attractive pockets of value. And then if we just look on the flip side of this, we are still finding a good deal of opportunity in the municipal bond sleeve, although this was fully allocated to closed-end funds just a couple of months ago. Here we're 70% allocated to closed-end funds, with the average closed-end fund trading at a more than 7% discount below NAV. And then lastly, in terms of our non-US equity funds, despite that big rally in non-US stocks that we've seen so far in 2025, we're still 63% allocated here, with our average fund holding trading at a discount of more than 8% below NAV. So taking a deeper dive into performance then for the TICE strategy, what this slide does is it actually decomposes the strategy's returns into the three core building blocks. So those are going to be capital appreciation, dividend income, and then what we refer to as closed-end fund alpha. So the alpha we're generating from buying those closed-end funds and letting the discounts revert back towards their long-term average. Now in Q3, we saw a positive return from the strategy, gained 4.92% on a net composite basis, with returns pretty largely coming from capital appreciation, with both stocks and bonds performing pretty well. You're going to see a positive 100 or so basis points coming from the distribution yield. And then in addition, we saw closed-end fund discounts closing, or that closed-end fund alpha piece that contributed an additional 64 basis points. And I think this slide just gives some really good insight into the benefit of using a strategy like TICE, where you've got the potential to benefit from multiple sources of returns, and in particular, that unique closed-end fund alpha component, which isn't traditionally accessible to traditional mutual fund and ETF investors. And then this is translated into strong relative performance for just about all time periods here. So near term, the gross composite led its benchmark by just over 40 basis points on the year-to-date period. And then over the long term, you're going to see outperformance of nearly 300 basis points annually over the last 5 years, and then 176 basis points annually since its inception back in October 2016. And then just in the bottom there, from a risk standpoint, since inception, TICE has exhibited a standard deviation that's going to be a bit higher than its blended benchmark, but that's going to be driven by the higher volatility nature of those closed-end funds. However, just looking at kind of tying that with performance, investors have been amply compensated in the form of that excess, those excess returns that we just talked about. And then just to wrap up the remainder of the presentation, we're going to switch gears again, talk about our TICE Alpha Opportunities strategy, or what we refer to as TAO. And just for those who aren't familiar, so TAO is a unique set of strategies. It's going to combine our TICE closed-end fund alpha strategy with a portfolio of undervalued assets. We refer to them as high conviction tactical assets. So everything that we've talked about so far, that is going to apply to the first half of the portfolio. So that's essentially an asset-weighted version of our TICE strategy. But in the next couple of slides, what I want to touch on is where we're finding value from an asset class standpoint for the second portion of the TAO strategies, and then how all that's kind of translated into performance. So starting with our long-term return expectations, returns across the board came down during the quarter, largely due to that strong performance that we saw out of both equity and fixed income markets in Q3. That said, though, we haven't really seen any meaningful shift in the general order of things. So if we start with equities, U.S. large caps, and in particular growth stocks, they're going to be at the far left with returns in the low single digits, while non-U.S. equities and commodities, they do still offer the greatest return potential over the next decade. We'll get into some of the rationale there in a second. And then on the fixed income side, the most credit sensitive sectors, so they've moved to the far left. So their returns are really going to be limited due to the very tight spread environment that we're currently living in. So we've got both high yield and investment grade corporates trading at spreads that are about as tight as they have been historically. This is despite yields still kind of looking attractive on an absolute basis. Now, on the opposite end of the spectrum, you're going to see EMD. That's had a banner 2025. That's had a year-to-date return that's in the range of 15% or so. And then we've also got longer dated treasuries kind of on that right side too, and they've become increasingly more attractive as the yield curve has steepened. And the way all this is kind of translated into the portfolio's asset allocation, that's what we have on the two pie charts here. So on the equity side of the portfolio, you're going to find our highest allocations of 55% and 35% to emerging markets value and international value, respectively. Commodities, they have a 10% weight. So this is going to be unchanged from last quarter. However, throughout the year, though, we have taken down that commodities position a little bit in favor of non-U.S. stocks, which has worked out pretty well. And then on the fixed income side of the portfolio, we continue to maintain somewhat of a barbell position. So you're going to see EM local bonds. That's our risk asset on one side of the portfolio. And then we balance that out with an allocation to short-term and long-term U.S. treasuries. Now, the longer-term treasury position, that was implemented during Q2, and we actually moved that up a bit in Q3. This has benefited the portfolio as the yield on the 30-year, that topped out around 5% back during the middle of the summer. And as we're recording this today, that's sitting closer to 4.6%. So getting into our rationale here for the next couple slides for our high conviction assets. So I'll go ahead and start with non-U.S. value stocks. So the major story here is valuations and fundamental improvement. Now, the valuation story, that hasn't really changed much. Non-U.S. stocks look particularly cheap, regardless of what metric you use. And this is on both a relative and an absolute basis. This has been the case for much of the last few years, but that fundamental catalyst, that's kind of been lacking. However, on a positive, it looks like that might be changing. So if we look at the right-hand side of this slide, you'll see GDP estimates for the US, Europe, and emerging economies. And that US exceptionalism story that everyone loves to talk about, that was on full display in 2024. We saw the US growing at a rate of 2.8% versus just over 1% for the EU. However, as you look out over the next number of years, that gap's expected to close pretty substantially, all the way down to just 30 basis points by 2027. So just a couple reasons for that. Europe is in a much better position to stimulate their economy. Just thinking about their fiscal situation, where in reality, we here in the US, we likely need some form of austerity just to get our fiscal situation under control. And then in addition, the technology sector, which has really fueled US growth over the last few years and accounts for a much larger part of our economy, that's actually expected to cool down a bit with earnings growth expectations for the Mag 7 names coming down substantially over the next number of years. So put this together, and from a valuation and a fundamental standpoint, it does appear that things are starting to support this international leadership story, and it does support the continuation of this trend that appears to have started here in 2025. Then if we move on to fixed income, emerging markets local bonds have experienced some pretty outsized performance this year. So they did have a pretty difficult Q4 last year, though. And despite rising by more than 15% on a year-to-date basis, we do still feel that there is room to run here. And there's really two reasons for that. So first, while spreads may not look overly attractive versus US bonds, with a yield on that index of around 6%, you're still earning a pretty healthy premium over the ag and US treasuries. And then in addition, a key contributor to performance this year has been weakness in the US dollar. But despite that weakness, we do still view the dollar as meaningfully overvalued versus the basket of EM currencies. And we think there's a possibility there of the dollar contributing about 2% to returns over the next market cycle. So stack these two components on top of one another, and you're looking at potential annualized returns in excess of 8% for this asset class, compared to our expectations of about 4 to 5% for US investment grade bonds. And then lastly, just on the asset class front, we've got treasuries, which have seen pretty strong performance on a year-to-date basis, with a lot of that price appreciation coming in just the last couple months. And I think this chart does a pretty good job of explaining why treasuries have done relatively well. If we look at the US yield curve at quarter end compared to just 2 years ago, you're going to notice that they look very, very different. So most importantly, it's no longer inverted. So that just means that the longer end of the curve yields more than the short end of the curve. But we've also seen rates come down pretty substantially from the very front end of the curve to about the 10-year point. And as a result, if you look at performance for bonds across the curve over this time period, over the last 2 years, the 2-year treasuries gained just over 11.5%. The 10-year has gained just shy of 12.5%. And then we've got the 30-year up over 9%. Now, from a positioning standpoint, coming into Q2, we had all of our exposure at the short end of the curve. However, with the curve now getting back to a more normal shape, we have taken some of that exposure down and added it to the back end of the curve. And if we just think about the reasons why, so historically, when the curve has been normally shaped, longer dated bonds have outperformed the short end. So this benefits a portfolio because now you're getting a higher yield as you start to step out in terms of maturity. That wasn't the case just a couple of years ago. And then in addition, what we'd also expect is investors to see more benefit from that extra duration should we actually hit a period of economic uncertainty. So an enhancement in that diversification impact. And then just to finish up with attribution and performance, here we see the recent performance of our high conviction asset classes compared to their policy benchmarks. On the equity side of the portfolio, our TAO strategies have done well versus their policy benchmarks this year. This is largely driven by that divergence we've seen in global equity performance, which was fueled by strong returns out of 9 US stocks and a meaningful weakness in the dollar. Commodities, they were a slight detractor. Here we've seen precious metals do exceptionally well, but those energy-related commodities, they have struggled a bit due to some supply and demand imbalances. Our fixed income assets also outperformed their benchmark. This is going to be largely driven by our emerging markets debt performance. So that's gained over 15% on a year-to-date basis. We see long-term treasuries. They're actually down a bit on the quarter. But if we look at them on a year-to-date basis, they now advanced by just about 8% through mid-October. And this is largely due to that pullback in yields that I was talking about a little bit ago. And then just to finally wrap up with the actual performance of the strategy. So on a year-to-date basis, all of this has resulted in pretty strong results across the board for our gross composites. So closed-end fund performance, that's been a little bit hit or miss this year with discounts being so tight coming into 2025. So what's really benefited the strategies are high conviction equity and fixed income assets. If we look at the strategy since inception, that goes back to April of 2020. First, starting with our most conservative strategy, income ops, that's gained just over 6% on an annualized basis compared to a gain of just 2% for the blended benchmark. Performance here, that's been supported by our closed-end fund alpha sleeve, so that's added meaningfully to returns for just about every year except for 2022. And then as well, on the high conviction tactical side, short treasuries and EMDs also added value, EMD in particular, in 2025. And then for Tau 80/20, our most aggressive strategy, you're going to see excess returns of 136 basis points annually over that same period. And unlike income ops, this is going to be largely driven by our positions in that the tactical asset sleeve. So if we look at commodities and non-US value assets, they provided a great deal of downside protection in 2022. And then if we look at this year, 2025, it's those non-US assets that have performed exceptionally well versus US equities. And what I think all of this really highlights is an important component of Tau, and that's its ability to benefit from these different sources of return. So you've got two. You have closed-end fund alpha and those undervalued assets, and they do tend to run in varying cycles. And what this does is it really helps us to provide competitive results across a variety of different market environments. And that's pretty much precisely what we've seen in practice since the inception of the strategies more than 5 years ago. So with that does it for this quarter's strategy update. If you enjoyed the presentation, please feel free to like, share, and subscribe. Also, if you have any questions or would like to learn more about our tactical income strategies, please feel free to reach out to a member of our advisor services team. You can see all their contact info on this slide, as well as our website address. Again, I just want to thank everyone for watching, and I hope you'll join us again next quarter.